Welcome to Get Rich Education. I'm your host, Keith Weinhold. We've got listener questions today about paying off debt versus investing, the real estate BRRRR strategy, and what exactly is the history of mortgage interest rates over the last 80 years, and how does that affect you? All today on Get Rich Education.
Are you looking for a roadmap to financial freedom? If so, we have a solution for you. Norada Real Estate is offering a limited number of free strategy sessions to help you get out of the rat race. Learn how you can create wealth and build monthly passive income. To set up a time with one of our knowledgeable investment counselors, simply go to noradarealestate.com. That's NORADA realestate.com.
For an income property investor like you that needs an income property loan, go to Ridge Lending Group. And over the years, you've heard owner Chaley Ridge generously give her time to you right here on the show as a guest. Ridge provides investment property loans in almost every U.S. state, and you're going to find out how they've helped more Americans realize their dreams of financial freedom through real estate than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com. Get Rich Education is brought to you by Ridge Lending Group, Producers Wealth, Norada Real Estate, and Total Control Financial.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Welcome to GRE, from San Jose, Costa Rica to San Jose, California, and across 188 nations worldwide. Hey, how you doing? I'm Keith Weinhold, and this is Get Rich Education. We've got some of your listener questions today. We'll start off with a more beginner-oriented question and then graduate to some advanced ones. Daryl from Houston, Texas says, Keith, love your podcast. I have a question about debt. I understand debt on income-producing property builds wealth, but what do you recommend about other non-secured debt? I have over $200K in student loan debt, and I struggle to decide whether to use my extra cash paying down that debt with interest rates rising, or should I use my extra cash to invest in rental properties and just pay the minimum on student loans? That would stretch the student loans out 20 years, and who knows what the interest rates will do over that time. However, I'm worried about losing time with investing. Currently, I am splitting it up and paying extra in student loans as I am able, and have purchased 2 cash-flowing rental properties in the meantime. Any insight you can provide would be appreciated. All right, well, great, Daryl. Now, just the fact that you both listen to this show and you're taking action says a lot of good things about your initiative and ambition. I love it. To me, it sounds like you've kind of got each foot in its own trough, 2 feed troughs. With your extra cash, you're feeding your student loan debt trough, and you're also feeding your cash flowing real estate trough, putting down payments on properties, as you've said that you bought a couple. Well, I don't know your student loan interest rate and other terms, but here's some more insight that I can give you. You know, I really think it just comes down to one short question, and that is, how has it gone so far? See, the fact that you've acted and bought 2 rental properties already gives you an advantage because you don't have to try to project what buying 2 rental properties would look like. You already know how it feels. Now, you refer to them as cash flowing rental properties. That was really important to me because apparently they are providing net positive income, as you probably expected at purchase. If you think that the cash-on-cash return from the rental properties will exceed what the student loan interest rate projects to be if it keeps going up, well, then that strongly tilts toward you buying more rental property rather than retiring the student loan debt. But if you think the student loan interest rate will exceed the property's cash-on-cash return, then you're probably better off feeding the student loan debt trough and paying that down. And yes, of course, the cash-on-cash return is just one of 5 ways you're paid in real estate investing, but importantly, it's the liquid one, and that's why it's important in case you run into financial difficulty in your life. And again, just for a moment, breaking it down to the very basics for a beginner here, your cash-on-cash return is your annual rent income minus your annual property expenses, which is cash flow. Take that cash flow, that number, and just divide it by your down payment or equity. That's your cash-on-cash return. So, Daryl, you're looking to create arbitrage, which is basically just a fancy-sounding word that means that you're borrowing at a lower rate and investing at a higher rate. That's effectively what you're doing if you decide to let the student loan debt linger longer in favor of pursuing more cash-flowing real estate. Then you have created arbitrage. Of course, if you have unsecured debt like student loans or credit cards and you want to qualify for real estate loans, you're going to need to pay attention to your debt to income ratio, that DTI, because loan mortgage underwriters define an upper threshold there. Thanks for the question, Daryl. Look, because Daryl took action and bought property, he has already eliminated a substantial component in any investor's mind. And what is that component or factor? He's eliminated a substantial chunk of uncertainty. Investors dislike uncertainty. Financial markets, the Dow, the Russell 2000, the NASDAQ, they hate uncertainty. And Daryl, you've eliminated the uncertainty of wondering how it feels to own cash flowing real estate, because now you're building a history. You've already got one, even if it's a short one, of actually owning some. And you know how it looks numbers wise and also how it feels gut wise. And hey, sometimes unglamorous things happen in real estate investing. This past summer, I had 2 clothing dryers stolen from the laundry room of an apartment building that I own. So just because I've been investing in real estate 16 years, it doesn't make me immune from bad people or stuff that just happens in the world sometimes. In fact, I've never even heard of that happening previously. I don't have any investor friends that have ever had laundry machines stolen. But now, see, if something like that happened to a brand new real estate investor, I think it would be really easy to lose faith in real estate investing, because human psychology is shaped substantially by our early experiences with new ventures. As you know, I strongly encourage you to get educated, take action, buy for cash flow, and over the long term, you will have a substantial opportunity to build lasting wealth, and you are highly aware of your less noticeable profit centers when you understand the 5 ways that you can be paid. The next question comes from Jennifer in Owasso, Oklahoma. She asks, Keith, love your show. My husband and I have had great success with the BRRRR strategy. I know it doesn't work in every area, but it's a great way to grow our real estate portfolio by using less of our own money. I'd love to hear your opinion of it. Thanks, Jennifer. Okay, first of all, the BRRRR strategy, which I'll just call the BRRRR strategy hereafter, means that you buy a property, the buy is the B, then you R rehab it, then R rent it out, then R refinance it, and the last R is that you repeat the process elsewhere. The buy, rehab, rent, refinance, repeat. That's the BRRRR acronym. This is where you're effectively treating the property as a flip. You're using short-term financing like private money, hard money, a home equity loan, or cash to acquire and rehab a property. And then after the property has had its renovation completed, it is rented out to a tenant. And you as the owner, you then obtain a refinance mortgage on the property to pay off the short-term loan and turn the property into a stable, long-term, cash flow positive property. Of course, the math has to work for your strategy to work. When you go to refinance a property like this, a bank will typically only refinance up to 75% of the new value. Therefore, for you to get enough to refinance the entire short-term loan and to possibly get back your rehab money, the property needs to be worth significantly more than what you paid for it. Now, I've got to run through a few numbers here for you to get an idea for why some people want to use the BRRRR strategy. So listen closely to this or rewind this part if you need to. I will go slow. I know this can be a lot to take in when you first hear it. Let's say you bought a property for $100,000. Now say that this property needs a $25,000 rehab to be rent ready. So at that point, you are all in for a total cost of $125K. Simple enough so far. You could use a short-term loan to buy this property for $100K, like hard money, because a regular lender doesn't want a loan on a property that's in disrepair. And then let's say you use your own $25K of cash on the rehab, okay? Post-rehab, you'd refinance the property with a new loan from a long-term lender, just like your plain vanilla 30-year fixed-rate mortgage. If the new lender's appraisal came in at $160K, they might give you 75% of that amount in a new loan, which is $120K. This would pay back your entire short-term loan, get you most of your rehab budget back, and give you a stable long-term rental property with some $40K of equity right from the start. Of course, this example only works if your ARV, your after repair value, comes out at this $160K level. It wouldn't be so great if the ARV were to come in at $100K and the bank post-rehab would only give you a loan for $75K, because that wouldn't even be enough for you to pay back the short-term loan. This is what I mean when I say the math has to work for the strategy to work. Now, I know that's a lot to take in when you're hearing it for the first time, so whether you caught that math or not, let's just distill it down for why some people really want to utilize the BRRRR strategy and why others avoid it. Okay, so some pros and some cons of this strategy here. The pros are that you can basically invest with no money down. You don't need a lot of cash. If the numbers work out right, you could get into a deal for very little money out of pocket, or perhaps even no money out of pocket. And of course, the better the deal you can find, the less money you'll ultimately need to provide. Another positive here is the high ROI. Because of the low amount of out-of-pocket cash that you're going to need for this strategy to work, your ROI could be astronomical. In other words, if you end up having only $10,000 in the deal, but you're cash flowing $2,500 per year, well, that's a 25% cash-on-cash return, and that doesn't even account for all the equity that you built up during your rehab stage. The BRRRR real estate investing strategy allows you to build some serious equity right off the bat. Rather than owning a rental property that is worth only what you paid for it, you could own one with $40K of instant equity in it. Okay, so we're talking now about the pros and the plus side of the BRRRR real estate investing strategy, spurred from a question by Jennifer in Owasso, Oklahoma here. Another pro is that after the full rehab has been done and the property is rented, well, now you own and lease a property in top-notch condition, and this can help you attract the best tenants and reduce your maintenance budget on the property, and that can create fewer management hassles. Now, let's talk about some of the drawbacks, the cons to the BRRRR strategy. The short-term loan you get at the beginning can be expensive, especially if you are using a hard money loan. High interest rates on your hard money loan can make your carrying costs expensive during your rehab, possibly resulting in negative cash flow during the time that you are making payments on this short-term loan. This is actually the reason that many people use a home equity line or cash to fund this first phase of the project and then refinance to get their cash back so they can kind of rinse and repeat. Another con is the risk that the property does not appraise for a high enough amount. This is how you could end up with a substantial problem. This is why doing the correct math going into the deal and having specific experience in that market is vital. With the BRRRR strategy, another hurdle that you probably need to deal with is called seasoning. The refinancing bank is probably going to require you to wait 6 months or 12 months after your original purchase before they will refinance the property. This is the period of time known as seasoning, and a lot of lenders require it. If your end lender requires you to wait 12 months, but your short-term loan is only good for 9 months, we'll see now you've got a problem. So a tip here is that you may very well be better off by making sure that your short-term loan is for no less than 18 months. This gives you the time that you need to refinance. And if something goes wrong after month 12 and your refinance won't work, you still have 6 months to sell the property or hunt elsewhere for a new refinance. Another con of the BRRRR strategy is that you have to deal with and manage the complications of a large rehab project yourself. You need a thick skin for rehabbing property. You're going to have to deal with contractors and their seemingly ever-changing schedules and all kinds of unknown problems that might include asbestos that you're going to run into, or theft of materials, or mold that you find, and all those headaches that come with a rehab that are just not very fun for most people. So there are the main pros and cons of BRRRR real estate investing. It's really kind of a hybrid between flipping and buy and hold, but it can be a powerful way to build wealth through real estate if you know specifically what you're doing, and you're willing to be hands-on, and you have a thick skin, and you're willing to devote your time, which really doesn't get factored into that cash-on-cash return. And it's going to help you if you live in an investor advantage market, and you may very well live in one. I know that Owasso is in suburban Oklahoma City there, Jennifer. Being able to capitalize on the forced appreciation the way a house flipper would while acquiring a great rental property that's going to provide you with years of cash flow is kind of like getting the best of both worlds. But BRRRR is not a simple undertaking. It requires some precise math, careful planning, a bunch of coordination, and you need the ability to find a great deal. You are taking on a challenge. Thanks for the question, Jennifer. As you know, we talk more about turnkey real estate investing here, where that stuff is all done for you. You already know your post-rehab cost. Rehab surprises are costs borne by others. You also typically already know what your rent amount is going to be in your rehab property, and that's because your tenant has already signed a lease, they've already moved in, and they're already paying that rent amount. With Turnkey, you have certainty and you have saved your time. Well, I've answered a couple listener questions about sort of what you can do. That was content. Next, I want to talk about historical context and how that factors into your investing strategy. What about the history of mortgage interest rates over the last 80 to 100 years and the lessons that you can apply from that today? You're going to find that FDR and World War II affected this substantially. That's next. I'm Keith Weinhold. You're listening to Get Rich Education. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get a copy of the QRP book by text messaging the letters QRP to 72000. That's text QRP to 72,000. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president of Producers Wealth. Producers Wealth assists people in creating, protecting, and perpetually multiplying wealth in any economy through creating processes that help them increase their production, provide them with liquidity, passive income generators, and opportunities for enormous growth. Learn more about their time-tested and proven systems at yourownbankingsystem.com.
This is Richard Duncan, publisher of Macro Watch. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. Most of our listener questions come from our contact page at getricheducation.com/contact. Please understand that I get way more questions than what we could ever answer on air, actually hundreds of times more. Now, I love it when I have a listener ask a question that also happens to live in my hometown. So I admit maybe I've given a little preferential treatment to Eric from Anchorage, AK. He asked through social media about the history of mortgage interest rates and he simply suggested that that would be a good topic for a podcast. Well, Eric, Freddie Mac only began tracking mortgage interest rates in the year 1971. The history before that gets kind of scattered and even murky sometimes, and I have spent some of my time looking at these 60 or 80-year-old mortgage rate charts, some of which look like they appeared in the newspapers of yesteryear. Here's basically what happened, and we'll start with the history of mortgage rates from the United States Great Depression. In the 1930s and 40s, there was not a lot of real estate business going on. For one thing, people didn't move nearly as often, then society was less mobile. Loans were 50% down, interest only for 10 years, and then a balloon payment where you had to refinance. It was common for entities like commercial banks and life insurance companies to be the ones issuing mortgages then. Then FDR's New Deal came along, part of which aimed to make housing more affordable, and this could even help explain why long-term fixed-rate mortgages are in existence today. One of the New Deal's program's purposes was to refinance those old balloon mortgages into long-term, fully amortized loans, and terms typically range from 20 to 25 years. Pretty soon, the Federal Housing Administration, the FHA, was created, and in 1938, Fannie Mae was born. This is about the time we saw lower mortgage interest rates like 5 to 6% and higher loan-to-value ratios, which meant lower down payments for borrowers. Now housing had become more affordable for more people. Loan-to-value ratios really started climbing between 1935 and 1940. Then 10 years later, when the veterans came back from World War II, the VA, the Veterans Administration, they wanted to give those veterans home ownership for zero down. And basically, here's how that went down. The banks told the VA that zero down was a terrible idea because if these borrowers flake out, banks contended, they're going to default and they're going to go into foreclosure, and then us as banks are going to be in trouble because we don't have any collateral. The banks basically told the VA, that's just too risky for us because the borrower's got no skin in the game. And basically the VA replied back to the banks, you don't understand. You're not going to loan them your money. And the bank said, what do you mean? The VA told them, we're going to pay you to put the paperwork together, but we've created new entities called Fannie Mae and Freddie Mac, and they're going to come up with the money. And if the borrower defaults, the government will step in and take the property back. So banks have no risk. They're not using their money, and they get paid to put the paperwork together. So to that, the bank says, oh, yeah, actually, that is a great idea. So then they got involved. So as those veterans came back from World War II in the late 1940s, this really helped fuel the economic boom of the 1950s. They started using their VA loans to fuel an expansion. And remember, we still weren't all that far out of the Great Depression. Some could advocate that this lending policy helped in at least one respect because during World War II, there was fear that after the war, we might be heading back toward the Great Depression. But instead, what happened with all this home buying is that it helped fuel an economic expansion. The lumber mills got busy. The carpet mill got busy. The appliance store business picked up. And labor got busy right along with it, building new homes in the 50s and later. The 30-year fixed-rate mortgage gained popularity in the 1950s. Now, by 1971, when Freddie Mac started tracking the rates, the 30-year fixed-rate mortgage was the standard, and there are good charts for tracking those rates. Of course, if you are a financial historian, you know what happened in the year 1971. In fact, it was a Sunday night, August 15th, 1971, when President Richard Nixon came on television and told America and the world that their dollars were no longer redeemable for gold. This made gold become much more valuable and dollars become much less valuable. Yes, that is high inflation. In fact, by the early 1980s, the 30-year mortgage hit its all-time high. The rate went so high because the Federal Reserve, headed by Chairman Paul Volcker, was in a war with inflation. In fact, the 30-year mortgage hit an all-time high of 18.5% in October of 1981. Yes, your parents or grandparents might have paid 18% or 15% or 12% for a mortgage loan. From that time, the rate spent the next 30 years generally edging lower, although there were some shorter-term bumps in there, bumps up. The year 2000 was the last time that the rate was more than 8%, and I just want to clarify here that we're talking about primary residence 30-year fixed mortgage rates here, of course. By late 2012, we hit breathtaking all-time lows of 3.3%, and today we're up off those lows, but rates are still astoundingly low, under 5%. Thank you for the question about historical mortgage rates, Eric. It's a topic that you don't hear anyone discuss very often, that's for sure. Well, that's more than just a condensed history that I gave you there. I want that to provide you with a framework of context and perspective because we can learn from history. After all that, here's one thing that we can learn. Do you know what the reported median mortgage interest rate is since Freddie Mac began tracking them in 1971? The median during these last now 50 years nearly. The median since 1971 is 7.7%. So that gives you some historical comparison on where we are today. Now, when interest rates go down like they have for much of the last 30, 35 years, investors get a sense of complacency, and so do homeowners. And why is that? Well, it's because you feel like you can wait a few months and rates will go lower. But at times like this, when rates are coming off their all-time lows, you feel a sense of urgency to buy and lock in your rate. I think that's one substantial lesson that you can gain from this history. You see, I love being a real estate investor with a mortgage because if I lock in my deal and then rates rise after that, well, I've already locked in my rate for 30 years, so it doesn't matter much. And if I lock in my deal but then rates fall, well, now I have the option to refinance. So while rates are edging up slowly here, you probably want to lock up your deal soon and then see you give yourself an option down the road. I love having options. In life, I'm looking for more options and fewer obligations. Did you know that some lenders won't loan on a turnkey property because the provider has not been the owner of record, also known as the title holder, for a long enough period of time? Like I mentioned earlier with the BRRRR strategy, that is called title seasoning. And since turnkey providers often only own the property for a very short period of time, many underwriters with large institutions will not make the loans you need to finance your turnkey investment. That's why I suggest a company like Ridge Lending Group that actually specializes in income property loans so that you don't have any problems that way. Well, I am living a life that includes some very long flights for international travel lately. Last week, I returned to Anchorage, USA from the Central American nation of Belize. It was so great to meet more of our listeners in person there in a dreamy resort place. I am about to leave tonight for 2 weeks to vacation in Italy and Switzerland. My flight that starts tonight ends up in Rome tomorrow, so I'll have to check the flight path. I'm not sure whether we fly up and over the Arctic or not. Speaking of long flights, I hope to meet you in person in just about 6 weeks at the longest running and probably the most prestigious investment conference there is right here in the United States. That is November 1st through 4th at the annual New Orleans Investment Conference in New Orleans, Louisiana. It's been running for 44 years strong now. I'll be appearing for a little meet and greet with you at America's longest running investment event because I'd love to meet you. I'll be at booth number 111, and I'll give you the exact date and time on that later. Just check out some of the names of past event speakers, and this is only part of the list whom have spoken there in years past. President Gerald Ford, Milton Friedman, Norman Schwarzkopf, Ayn Rand, Charles Schwab, Dick Cheney, Jim Rogers, General Colin Powell, former Fed Chairman Alan Greenspan, First Lady Barbara Bush, Ron Paul, Margaret Thatcher, and Steve Forbes. And despite all those esteemed names, there are plenty of sessions for novice investors and even a lot to learn for someone that's never invested at all. Like, I promise that you won't be watching these presentations and think that every one of them are over your head and like it's just too much for you. You're going to do some learning. The whole event is super affordably priced for you too. Now, the 2018 New Orleans event speakers for this year are also people that you will have a chance to meet in person. And this year's speakers include a number of guests that I've hosted here on the show, including Robert Kiyosaki, Peter Schiff, the real estate guys, Tom Wheelwright, Chris Martinson, and so many more that are going to be there in New Orleans. And this is all besides the learning, investment ideas, networking, and new friendships that you're going to enjoy at the conference. I mean, really, how many chances in your life will you have to meet Robert Kiyosaki, the greatest selling financial author of all time anyway, the author of Rich Dad, Poor Dad? At the meet and greet, you and I can chat, I can sign your book, and we can have a photo together. I'll give you the meet and greet date and time later. In New Orleans, while you're attending the sessions across the hall from where the booths are, you're going to learn how Trump's economy will affect real estate and the larger economy. You're going to listen to a lot of well-known and impactful speakers speak. You're going to meet like-minded people, make friendships, meet your heroes and thought leaders in person, discover all kinds of powerful investing strategies. And besides real estate, there are also presentations and booths about precious metals, actually a lot of precious metals there. Also energy, currency, stocks, and more. And consider taking some extra days in New Orleans. It's just a really cool place. Decatur Street, Bourbon Street, the French Quarter, Mississippi Riverboat tours, Cajun food, haunted attractions, alligator tours, and even the New Orleans Saints play a home game then. November 1st through 4th is a Thursday, Friday, Saturday, and Sunday. I want to meet you there. It's going to be my third time at the New Orleans Investment Conference. And who knows, if you're into lifting weights or going running outdoors, maybe we can do that together on one of the mornings too, just like I did with some of our listeners on our investor tour in Belize recently. You'll learn more about how we can meet at the New Orleans Investment Conference when you get our free newsletter. Sign up at GetRichEducation.com. Whatever you do, I want to remind you that what you do today is important because you are exchanging a day of your life for it. Thanks so much for listening and telling me that this show is an important part of your day. And if I've ever provided any value for you with this show, please share it with a friend. Go ahead and take a screenshot of your podcast listener interface here and put that screenshot on your Facebook or your Instagram or your favorite social media account. I would be grateful. Until next week, when I'll be back to help you build your wealth, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Ranked by Forbes as one of the fastest growing cities, Orlando, Florida has a big and diverse economy, yet still features affordable rental properties that cash flow. Our boots-on-the-ground turnkey provider, Greg Bond, wrote a special report to help you discover the amazing market of Orlando. Request your free copy today. Visit GetRichEducation.com/Orlando. That's GetRichEducation.com/Orlando.
71% of Americans aren't saving enough for retirement. It's going to get worse as people live longer, and you need to start thinking differently. But you can't lose your time. Real estate is the investment vehicle that's made more ordinary people wealthy than anything else. Keith Weinhold of Get Rich Education is host of one of America's top investing shows, Disrupting Wall Street. He's an international best-selling author, a writer for Rich Dad Advisors, and has been an active income property investor since 2002. He has created thousands in passive monthly income for countless followers, and now he has a free book, The 7 Principles for Creating Wealth in Your Life. Get your copy now at GetRichEducation.com/book. That's GetRichEducation.com/book. Because invest in what produces income for you now and later. Keith Weinhold is your guy. Sign up now at GetRichEducation.com/book.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.